Hi there, you're watching BloombergQuint, and this is the fine print. In a surprising move last evening, the tax department notified the thresholds for a new digital tax in India, better known as significant economic presence provisions introduced by the Finance Act 2018. The SEP tries to or seeks to enlarge the scope of income of non-residents that accrues or arises in India by establishing a business connection of the foreign entities in India. It was first mooted in 2018, then in the Finance Act 2020, the government defined the scope and gave a definition to SEP provisions. And now the CBDT has notified the thresholds that will apply to SEP provisions. The intent is to essentially tax those, the profits of those offline and online businesses that don't have a physical presence in India, but derive significant economic value either through large transaction value or a large user base. So what is it that the CBDT has notified yesterday? It has notified first a transaction threshold. Any non-resident whose revenue exceeds 2 crore for transaction in respect of goods, services, or property with any person in India. This will include transactions on download of data or software. The CBDT has also notified a user threshold, which means that any entity that systematically and continuously does business with more than 3 lakh users in India. Now, why I call this notification surprising is because last year, the finance minister had deferred the SEP provision, saying that OECD is also seized of the matter, and we're all waiting for consensus to emerge via the OECD platform on how profits of entities that don't have a physical presence in a country but derive significant economic value from their jurisdiction should be taxed. Now, even as we all wait for the OECD consensus to emerge, the tax department has gone ahead and notified these transaction and user-based thresholds. Why did we do that in such a tearing hurry? What will be the impact of these new thresholds that will now, tax these businesses starting April 2022? And what does it mean for businesses that come from jurisdictions that India has a double taxation avoidance treaty with? To answer all these questions, I have with me Sudhir Kapadia of EY. Mr. Kapadia, thank you for joining us here on the fine print. I hope you're doing well in these difficult times. Mr. Kapadia, I'll open with a very basic question. Were you surprised that the CBDT went ahead and notified these transaction and user-based thresholds, given that we are waiting for the OECD Pillar 1 and Pillar 2 report to be made sort of public as yet and get consensus on?
Yeah, as you said, I thought the intent was to align and see what is coming out of those deliberations at the OECD. I think the signaling has been already done by India by introducing this principle and this concept in 2018 budget, as you rightly pointed out. If I can just explain a little my point of view as to why I'm saying this signaling was important, it's because, as we know, that the current double tax avoidance treaties which we have with almost every major country in the world, like all other treaties, essentially define a permanent establishment or a business presence in the classical bricks and mortar sense. Basically physical presence through people, through office, through equipment, etc., etc. Therefore, and linked to that, it is not possible to amend so many treaties at one go. So it was important for India to signal that this is the direction in which India would like to move, as indeed so many other countries who are kind of user countries of digital commerce certainly would like to move, which is to have some form of taxation where digital commerce is carried out without physical presence. So that is the signaling. Now, why that signaling has to be done by way of an amendment in the domestic law, therefore, is because, as we know, India has had a very long-standing principle of provisions which are more beneficial to the non-resident to be applicable, i.e., whether the provision is in the treaty, relevant treaty, or in domestic law, whichever is more favorable will apply to a non-resident. And by the way, India is in that sense quite unique because without getting into too much detail, most countries, including the United States, don't have this principle necessarily. For example, in the US, a subsequent amendment in domestic law shall prevail, regardless of a prior treaty being entered into. And that
Yeah.
has also found favor with the US Supreme Court. So India has had this principle, more or less. There are some exceptions, but more or less enshrined in Section 90 for a long time. Therefore, I think what signaling India has done is to say that, look, we have to move ahead and have some form of taxation for digital commerce in these circumstances. Unlike the equalization levy, as we know, the significant economic presence kind of definition has been made subject to treaty provisions.
Yeah.
So it was very clear that this cannot be a revenue raising measure in the short term, because most of the situations will be covered by a tax treaty.
Yeah.
And tax treaties, as I mentioned earlier, obviously are not yet amended, unlikely to be amended till a consensus emerges at the OECD. So when you keep all this in context, I agree with you, Payaswini, that that is why this particular threshold notification has come as a surprise, because it is not going to result in any significant revenue impact in the immediate term, to be specific, in this financial year rather. Because obviously non-treaty situations are going to be very limited,
Right.
where this provision will likely kick in, but it will create, avoidable uncertainties for smaller businesses which are operating in this space, because the threshold limits
Sure.
are very low.
Sure. So I'll come to the impact on the kind of businesses and also, on the threshold specifically. I'd like to first also understand, and also for the benefit of our viewers who are sort of coming in new to the SEP provision, um, world over, jurisdictions, like you also pointed out, are struggling that there are businesses who deal with the domestic consumers of a jurisdiction, but are not able, but they're, because of the lack of physical presence, the tax law is playing catch up. Because conventionally these businesses go untaxed and they generate significant revenues from that domestic jurisdiction. Could you give us a flavor of, and that would include, because you might hesitate to take those names, the large tech groups, as we know, whether it is your Facebook, Alibaba, Amazon, and the like. Could you give me a flavor of the kind of transactions that the SEP provisions are seeking to bring within the tax net in India?
So it would, today, I mean, simply put, it would be all kinds of digital transactions which result in a taxable income. Uh, so let's divide into two. Arguably, there could be simply internet surfing which happens, which is only informative, it's only for information. So there is no real income, or there is no, there is no, directly at least, there is no income generated in the process. And there would be actually payment transactions where you actually pay through through the paywall, through digital, which clearly results in an income. So the second part certainly does get captured. Now, interestingly, if one reads the carefully the provisions in the Indian
Yeah.
amendment, they do also emphasize use of data or income generated by use of data. Now, practically, how this will be implemented is a big question mark, but it does seem to indicate a desire or an objective to say that where Indian data is being used, and we all know the whole debate on use of data and how that is being sought to be monetized. Now, that's practically going to be quite difficult in my view, because how is the data utilized through algorithms, through various other means, to give indications to marketeers, to businesses at large all over the world, to tap certain markets, therefore to garner advertising revenues. I mean, it's a whole complex, business subject, and to pinpoint and say this is how, therefore, incremental income arose to a service provider or to a business because of data collected is going to be very tough. By the way, this is not new. It is something which OECD is also grappling with. So to step back, I think the direct income part clearly is something which is easier to at least determine, in terms of quantification, because those are
So is it
directly,
as simple as, let's say, transactions? I know we don't have a treaty with Cayman, for instance. Is it as simple as that, let's say, a hotel in, let's say, Cayman, that gets booked by, let's say, more than 2 lakh Indian users, gets within the tax net of Section 9 now?
yeah, in that hypothetical example, yes, I don't think 2 lakh Indians go to Cayman, but there are other
Sure.
interesting
In
jurisdictions where
jurisdiction.
you might
Sure.
find. But
Just
it,
Cayman
that's
was
a
on the
good
top of
example.
my head.
Yeah.
Yeah.
So what I meant was the one part of the equation, Payaswini, in your example, the revenue part is obviously easier to track. What
Sure.
is
Yeah.
interesting is, it's not the revenue per se, it is the income which is
Yeah.
subject to tax. And that's where I come to the second part of this, issue, which is really to say the quantification part. Because in your example, how do I attribute the expenses which that Cayman hospitality company has incurred in the process of earning this income? Now, even in the physical world, this whole allocation of global expenses is a huge issue. And
Yeah.
in India, we have had a rich history of litigation on that front. Interestingly, there is a very old world, I would say, provision, if I may use that term, in the income tax law, actually in the rules 10D, which seeks to have a very, I would say, elementary kind of allocation, basis India revenue upon global revenue multiplied by expenses. So in your
Yeah.
example, whatever is the revenue these Indian travelers are giving, divide by the total revenue of the company, multiplied by their total expenses would be the expense attributable to the India use or the India access. So there would be some
And
of
then,
those
I mean,
very.
how's the tax department? Let's say, I'm just trying to sort of understand the mechanics of this provision. How's the tax department going to collect this tax? Because that entity doesn't have a physical presence in India, right?
Yeah. So that's an interesting one. That what would make this Cayman company comply with
Yeah.
Indian tax laws. It's a so my sense here is, and in a way, a little bit of worry also is that if I step back for a very different objective, it's not directly comparable, but to deviate just for a moment and give an example, we have introduced in India what is called tax collection at source by authorized dealers for foreign remittances under LRS, right? Now, this arguably is something to do more with tracking and trying to basically see whether there is any income escaping taxation. But with the mission creep, as I call it, in the whole area of TDS and TCS, it would not be inconceivable tomorrow for our lawmakers to say, okay, now the best way to ensure this is to have a tax at source.
Okay.
And because there is an authorized dealer in the Indian context always involved when I remit the money, in some way to put that obligation on the authorized dealer. Practically, it's not going to be easy because online transactions I can pay directly. It's
Correct.
not like a remittance through an LRS. So, but all I'm saying is that unless you have some kind of withholding mechanism at source, it is not going to be easy because arguably, in this example, you could say that, look, why would a Cayman non-resident subject itself to jurisdiction in India?
Yeah, okay. There's also another interesting aspect of the definition of SEP. The mechanics, as we discussed just now, seem to be a little tricky, and we're all unclear on that. But the scope is a little larger than just digital tax, right? Because it's also sort of talking about property-related transactions or goods. Um, in terms of the scope, is the SEP provision sort of in India broader than what's being contemplated in a lot of other jurisdictions?
It's a bit intriguing. I agree because, in fact, when you compare the earlier law, the draft, I mean, there's a difference between the finally passed act and the bill, and
Yeah.
it had the terminology through digital means, which has been
Yeah.
omitted later. I don't think there is any explicit explanation given for that, and that is where the doubts, which you have rightly said, do arise, and that is a bit inexplicable because, as we discussed, we already have a very, very well settled definition of business connection in the domestic law. which
Yeah.
has, there are circulars, there are case laws, of course, it's fact specific. So now to introduce this and create one more layer of uncertainty to say, regardless whether I have a business connection or not, if I am selling goods, which title passes outside of India to the extent of more than 2 lakhs of rupees, then does it mean it is taxable regardless of whether there is a business connection in? So those kind of questions will arise. So at least in my personal view, I think India should uh, be focused on the digital aspects, because
So
that is
that's
what the
the point, is that I get this. I get this urge to tax transactions in the digital world, where there is some logic to say that, look, you're selling so much to the Indian user base, but nothing, no tax revenue is coming to India. I get that logic, but what are
yeah
these transactions in the physical or the offline world, if I can call it, that
yeah
are
so
escaping the tax net? Because I believe if the goods are going to come into India eventually, there's got to be customs and all sorts of those taxes on it. So I'm just trying to understand, what are these transactions that come under the SEP provisions now?
no so let's divide into two, Payaswini. So first, to your first point, the levy of customs, by itself should not extinguish the income tax liability, if any. So
Okay.
any government has a right to, frame a law to say
Okay.
income tax
Fair point.
is on income. So that is maybe besides the point. I guess the issue is the following. Leave aside the SEP. Today, if I am importing goods, right, from outside of India, as you rightly said, there is applicable customs duty, but pretty much nothing else. Of course, after I import and I sell, there is GST. So there
Correct.
are indirect. So it has been a very well settled position in India, at least, that importation of goods where title passes outside of India, doesn't result in an income tax provision, income tax levy. It does result in other indirect taxes, correct? By itself, it doesn't. Of course, if it is in the course of business connection, all of that is a different story. To the extent that this particular provision seems to suggest that this can be now a deviation or an exception, where even if it is a pure and simple import of goods with title passing outside of India, but exceeding the threshold of 2 crores, then it could be subject to tax under SCP, creates unnecessary confusion. Of course, then you have the treaty and all of that. But the point I'm trying to make, as you rightly said in your earlier comment, that the intent all along appears to be to capture digital transactions, which is a fair, which to be fair, it's not something you can grudge any government in today's context with all that is happening at OECD. That's pretty okay in terms of the objective. But to create this kind of a backdoor, if I may say, attempt, whether consciously or otherwise, can't say, to tax physical transactions, I think is a layer of uncertainty which is avoidable. Again, I do not see a huge revenue mobilization on this count, because it is just going to apply to non-treaty situations,
Yeah.
and uh, and therefore all the more reason why, in my view, this should be clarified sooner rather than later, and make it clear it is only for digital transactions.
Okay, so we've discussed and agreed to the fact that it's not going to raise large revenue for the government, because India has what, about over 90 tax treaties, and with major trading partners and jurisdictions where some of these companies are located, which do large digital transactions or have a large user base from India. We've also discussed the fact that the mechanics of collection of this tax are going to be cumbersome. We've also discussed the fact that it's much larger in scope compared to some of the other jurisdictions that are looking at digital economy. We've also discussed the fact that we still don't know the extent of maybe um, you know that whether or not this will impact businesses in the sense that the government is actually trying to cover. Let me now come to the threshold bit, Mr. Kapadia. Um, Whatever minuscule impact this tax might have, how does this threshold compare with let's say, what's been proposed in Europe, what's been contemplated at the OECD level? How do these thresholds stand?
No, I mean, of course, the countries, purchasing power and all come into play. So it's difficult to compare in that sense. But you have raised a very important point, Payaswini. If we just go back a little bit in the context of, initially in the first round of BEPS related recommendations, there was this whole recommendation to keep appropriate documentation on global transfer pricing, if you
Yeah.
recollect right in the beginning. And that time, India took the view, it was pleasantly surprising, you might say, that these requirements will the same threshold as it was in the OECD, which was
Yeah.
a very high amount, something to the nature of 730 crores turnover or something in those days. So it is not unheard of that India has adopted thresholds which are OECD or EU determined, whilst applying a similar provision in India. It could have been done here. Second is, having said this, of course these were put out in public consultations, and I don't know what kind of representations were received by government, by CBDT. But what is not coming out is that what is the basis for this? It seems to be a figure kind of pulled out from somewhere. It
Yeah.
doesn't seem to
Yeah.
indicate what has been the basis for this. Is there any particular, data on which you say, okay, the average, spend is so much or something like that? So unless there is a sharing or disclosure of what the base is, very difficult to, opine on why these figures have been kept this low. But certainly they seem to be too low and would capture unnecessarily a large number of transactions, which will be in aggregate not result in a huge amount of revenue mobilization, but individually could result in potential tax compliance issues.
Okay. I'll leave it at that, Mr. Kapadia, that we don't know yet a lot about this levy and how it will play out, given that, a majority of the jurisdictions may be out of this net because the tax treaty in its present shape and form is more beneficial for them. And it's unlikely that until, April 2022, we'll be able to negotiate all our tax treaties. My final question then is that, um, is this can we view the tax department's action of notifying these thresholds as a signal to the OECD that look, you need to come to a conclusion fast because we're running out of patience?
Yeah, that's yeah, that's an interesting one. The Payaswini, my view is which I kind of alluded to earlier, that signaling was required and was done through the amendment itself in 2018. I think that is the signal which a policymaker would look at in
Hmm.
OECD.
Yeah.
These threshold limits by itself, are meaningless from a policy point of view, because India gave that signal that okay, we want to introduce now. You are right, we
Yeah.
won't wait forever. But as I said, let's assume that OECD delays its consensus, which could be very likely the way these things move beyond 2022 goes to 2020. How will life change on the ground till
Yeah.
I as India am able to amend my treaties with treaty partners, and treaty partners can always come back and say there is no consensus at OECD, so we can't agree to any amendments immediately. So by itself, the threshold, I don't know what it could, but yes, if there are sufficient number, and that's what I was saying, that if that data is available, that how many
Yeah.
non-treaty businesses deal with
Correct.
Indian users at
Users.
large,
Yeah.
how many non-treaty businesses have this kind of revenues collected from India, individually exceeding 2 crores. That would be a very good, maybe that information is there with the department. That could be a very good signal to say, look, there will be in
Yeah.
aggregate so many thousands of potential taxpayers in the framework of OECD to say, guys, deal with India, do something about it, because we are already now having this headache of compliance. Then what you said could easily play out, but unless we have that data, it's difficult to come to that conclusion. So yeah, I mean, so the other way to put it is that where was the need to hurry through this kind of threshold limits when the revenue mobilization appears to be very, very modest, if at all. It's really, really difficult to say.
All right, Mr. Kapadia, it feels like at the end of this discussion, we've raised a lot of relevant and pertinent questions related to SEP, but for the lack of data and clarity on, why the government did what it did, it seems like, we're still going to be have a lot of questions at the end of this discussion, which I hope the tax department clarifies next year or soon. Until the OECD.
I just add the Payaswini. One point is that let's just one example in this where it could be, and this is just a conjecture. If we recollect the principal purpose test, which was also suggested earlier as a potential amendment to the treaties, because most treaties had limitation of benefits, what circumstances a treaty would apply, not apply. Many countries have now their own general anti-avoidance rules. Now, interestingly, the project which OECD undertook at that time, as you would know, was to say, okay, you don't even need to do bilateral amendments. This is the superimposition. The superimposition of the PLI will be. So actually, you have a set of documents which today tell you that the treaty between, let's say, India and X country, provided the other country has signed up, will now read as follows, without the actual exchange and ratification of the treaty. So this is one thing which we have to bear in mind, that this could be, just a conjecture. This could be the direction where, as you said, countries like India and other major user jurisdictions put pressure on OECD and say, okay, we can't wait. By the time India finishes, amending bilateral treaties with each of the, as you said, 90 plus countries, it would be like 90 years. So what is the likely outcome if there is a reasonable consensus is on the lines of the PLI and other similar amendments where it will be a superimposed amendment. And therefore, the timeline may not be as far away as ordinarily one would think.
Well, hopefully for the Indian government. Mr. Kapadia, thank you for patiently explaining to us what these threshold notification means for India from the revenue point of view for the treaty partners and non-treaty jurisdictions that do business with India. Thank you for joining us here on the Fine Print, and thank you so much for watching.
Thank you, Payaswini. Take care.